Hello everyone, in this video we will be doing the chapter 5 of ACCA F3 Financial Accounting, and the chapter's name is Returns, Discounts and Sales Tax. So before watching this, make sure that you have watched the previous videos as well. The playlist of everything is given in the description box below, and I'm also going to make some videos in which I'm going to solve the Kaplan study kit, so make sure you watch them too. I'll link that also in the description box below. And we are going to study from the Kaplan study text. So in this chapter we are going to understand about the various types of sales tax, returns and discounts which take place in a business, and we are going to see their entries, the way we put and record their entries in the ledgers and journals. Okay, so let's get started. So in the previous videos we had learned how to make journal entries, and we've also seen how to make the ledger accounts. So if you are clear with them, you'll be clear with this as well. So what is the overview of this chapter? So we are going to update our ledger accounts, and then we are going to take account of sales and purchase returns. So you know what sales and purchase returns are, right? And trade and settlement discounts. We will talk about what trade discount is and what settlement discount is. And settlement discount is the other name for cash discount. So take a note of this. Settlement discount is also known as cash discount. So I hope you are noting this down, because this is not like business and technology paper. This is something where you need to keep a notebook handy and you need to note down the things which I'm saying. Otherwise, there's no point of watching this video. Okay, and then we are going to also look at how we will take account of the sales tax. This chapter continues to build upon the principles introduced in the earlier chapters. In particular, it considers accounting for sales and purchase returns, the different types of discount, and also sales tax. Much of the content of this chapter is new, however, it is an important foundation for your future ACCA studies, in particular for financial reporting. Okay, so let's talk about how we are going to record the sales return and purchase return. And before this, I hope you are clear with what sales return is and purchase return is. Even if you're not clear, let me just quickly revise it. So purchase return is when we return some of the purchasing items back to our supplier due to various reasons. Maybe we're not happy with it or whatever. And sales return is when our customer returns back the stuff because they are not happy with the items. Okay, so let's start. I'm giving you a minute so that you go through the 3 pointers and write down whatever I told you. Okay, so these are the items which are to be learnt in this chapter. Now let's move on. Yeah, my pen was not working, now it's working. Okay, so it is normal for customers to return unwanted goods to a business. Equally to the business will occasionally have to cost to return unwanted goods to the supplier. The double entries arising will depend upon whether the returned goods were initially purchased on credit. So whenever, okay, wait, I'll first explain something to you. So when there are two ways in which a transaction takes place, either cash basis or credit basis, right? So let's talk about sales. So when there is a cash sale, what is the journal entry? Cash gets debited and sales get credited, right? And whenever we have a credit sales, what is it? Credit sale is nothing but receivables account gets debited and sales gets credited, right? Okay, and now whenever we have a sales return, what is the entry? You give their cash back, right? So here what would it be? Sales return or sales account, whatever gets debited, this is the return. and you give out the cash back to them, right? And the same thing with the receiver. What happens with receivables? We will look into that also. So what happens? So sales returns again gets debited, and the receivables get credited. So this is basic stuff. This is just putting a reverse of the original transaction. I hope you're clear with this, no doubts in this. Now when you talk of, this is what is of sales, entry of sales. I hope you're writing it down. Now let's see what happens when a purchase transaction takes place. Purchases. So when purchases happens, tell me what happens if it's a cash and what happens if it's a credit. Okay. So when you purchase something, what happens? Purchases gets debited and cash gets credited, right? I hope you're clear with this. And what happens when you take something on credit? So purchases again gets debited and payables gets credited. No doubts in these, right? Clear? Now tell me what happens when a purchase return takes place. So when a purchase return takes place, you are just going to do nothing but the same thing again. This time the cash will get debited and purchases return will get credited. Purchases return will get credited, right? Now let's do your test to understanding. This is based on the journal entries which we have learned. So the first one, Alfie transfers $10,000 of his personal savings into a business bank account. So what is a business bank account? That is nothing but the capital, right? And his cash. So the capital increases and what happens? The cash also increases in the business. That's you need to underline. Business bank account. So our journal entries are always based on things which are related to the business. So by this transaction, what is happening? The cash is increasing in the business and the capital is also increasing. So what is the journal entry? The journal entry is cash account gets debited and capital account gets credited. By how much? $10,000. $10,000. Okay, let's see the second question. He then buys goods from Isabel, a supplier, for $1,000 and pays by check. Pays by check, which means pays by cash. So you know this is very easy. This is purchases to cash, right? This is nothing but purchases gets debited to cash. How much? By 1,000. Right. Now let's see the third one. A sale is made for $400. The customer pays by check. So this is nothing but cash to sales. Okay. I think you can do it by yourself. I am writing the entry here. Note it down side by side. Cash in sales. Sales gets credited by how much? $400. Alfie makes a sale for $600 and the customer promises to pay in the future. The customer promises to pay in the future. What does that mean? What does that mean? Bills receivable, right? Which is an asset for us. So bills receivables account debit to credit is sales. So this is nothing but debit bills receivable and credit your sales. Fifth one, Alfie then buys goods from his supplier Cayman for $500 on credit, which means bills payable, right? So debit the purchases account and credit the payables account. So this is nothing but debit the purchases account and credit the payables account. Okay, next. Alfie pays a telephone bill of $150 by check. So he's paying the telephone bill by check, right? So cash is reducing. So and expense is increasing. So telephone expense gets debited and cash gets credited. So this is nothing but you debit you debit the telephone expenses and you credit cash because the cash reduces. The credit customer pays the balance on her account. So who was our credit customer? This one. So the credit customer pays the balance on her account, which is nothing but 600. So now cash is being received and the payables are getting reduced, right? And the receivables, and the receivables are getting reduced, right? Now, um, which one is the next one? Alfie pays came in 340. So let's go back to that. He had to pay 500, but he paid 340. So that much gets reduced. So payables gets debited and from cash. So payables gets credited and cash credit cash. So how much is that? It is 340. Bank interest of $30 is received. So bank interest gets received. So what is that? Tell me. Bank interest of 30 is received. I'm giving you a minute for you to think on it. Yes. So it is nothing but cash gets increased and interest income also gets increased, right, by 30. Next, a cash customer returned $20 goods to Alfie for a refund. So a cash customer refunded 20. So let's come here. So a person, what did he do? He came for a refund, which means he returned the things which he had bought for cash, not credit. Why? Because it's given in the question. So we have already done the journal entry. So what is the journal entry of sales? Initially, what was it? Cash account debit to sales. Sales gets credited, right? Now it gets reversed. Sales returns account gets debited and cash gets credited. Sales returns get, let me write it here, we debit sales returns and we credit, what do we credit? And we credit cash, right? So this is for 20 and 20, right? 20 and 20. So you know how that works, right? We have done these entries. Alfie sent goods of $100 back to Cayman. So this is nothing but purchases return. What was the initial purchase transaction? Cash account debit. Sorry, purchases account gets debited and cash account gets credited, right? Now it's just the opposite, which is nothing but cash account gets debited and what gets credited? Purchases return. Now tell me, what have I done wrong in this transaction? There is a mistake in this transaction. Now I want you to think and tell me what is the mistake in this transaction. Go back to the question again and let's go to the initial transaction of Kamen. Alfie then buys goods from Kamen on credit. So we had never given him the cash. So what should be the transaction here? It shouldn't be debit. It shouldn't be debit. What should it be? It should be payables. I hope you understood why I have done this. Because when this transaction took place, what happened when this transaction took place? We have not given Kamen the cash. We had taken the goods on credit. So now the same thing, the opposite transaction will also be on the basis of credit. So that's it. We are done with this test understanding. See, it's that easy. This is really very, very easy. There are just 2 new journal entries which you had to keep in mind. Okay, now we come to another topic and that is the discounts. So let's understand what discount really means. So I'm giving you a second, just read it and then I'll explain it. Okay. So, trade discounts are given to try and increase the volume of sales made by the supplier. By reducing the selling price, buying items in the bulk then becomes more attractive. If you are able to source your products cheaper, then you can either earn more profit on each item you sell, or you can reduce your selling price and make your goods more commercially attractive to customers. For example, if you were to buy over 1000 items, the supplier might be able to reduce the price of those items by 5%. Okay, so what do you understand by trade discount? Let me first explain that to you all. So, trade discount. So, the main reason why suppliers give trade discount is to attract more volume. It is to attract more volume. More volume, what does that mean? It wants the customers to buy in bulk. They want to sell their goods in bulk. So this is how a trade discount is given. So they reduce the price of the items. So when they reduce, now let's see what how do we account for a trade discount. Okay, here there is a blur, so something has been missed here, but I will read it out for you. From an accounting perspective, trade discounts are deducted at the point of sale. When accounting for a sale that is subject to a trade discount, it is the net amount that should be recorded. The trade discount does not get recorded separately. Okay, now let me first explain it to you guys about how do you record a trade discount. So now we understood what a trade discount really is. So, and how do you record a trade discount? So, we never really show the trade discount in the books. So, in the books, we never show what exactly is the trade discount. We always show the net value. Now, you know what net value is. Net value means that you are recording the amount of goods after minusing the trade discount from it, right? So trade discount is always, let me just write it down for you guys. Give me a second. Yeah. So trade discount is never recorded in the books. Discount is never shown in the books. Shown in the books. It gets deducted. It gets deducted from the total value. So that is that. So hope this is clear. You understood what I'm trying to say. So you always record the net amount. So right now don't get confused with what it is, because we will be going forward and we'll be coming to the examples. Now let's go to our test your understanding. Oliver sold goods with a list price of $1,000 to Sam on a cash basis, and and allowed her a trade discount of 10%. Okay, so now we need to show how the above thing should be recorded in both the books of Oliver and Sam. So first of all, let's see the value. What is the value? It is $1,000. And what is the trade discount? Trade discount is 10%. And what is the 10% of $1,000? 10% of $1,000 is nothing but $100. So we know that it is $100 is the trade discount. So how are we going to record this? Let us first record it in the books of Oliver. It would be sales, right? So it would not be nothing but cash account debit, right? Debit cash account and credit sales account. This is in the books of Oliver, right? So what will be the value? Value is going to be 1000 minus 100, which is 900. It's gonna be 900. And what will we write in the books of Sam? We're going to be writing purchases, debit purchases and credit cash. How much? This is also going to be 900. Why is it going to be 900? It's going to be 900 because this is a trade discount, and in trade discount we always show the net value. Even though dollars worth of rupees 1000 have been goods worth of rupees $1000 have been sold, we will still be writing it as $900. Why? Because trade discounts are never shown in the books, and this is how it is. You always write down the net value, and in the net value we subtract the trade discount. So that's about it. We are done with the test understanding too. Now let's see what's next. Okay. So now we have what is known as settlement discount. So before we begin with this, I need you all to understand that settlement discount is also known as the cash discount. So when it comes to settlement discount, you need to know that there are, first let's say, there are two types of discounts. The first one is cash discount. Cash discount is also known as settlement discount. And the second type of discount is what we have already seen, and that is the trade discount. So I hope this is clear for you guys. Let's move on. Okay, so what is a settlement discount? This type of discount encourages credit customers to pay for goods and services purchased quicker than they otherwise mean to do so. If you pay for the goods within a set time limit, then you will receive a percentage of discount. This may be referred to as a cash discount, or as early settlement discount, or as prompt payment discount. So why are cash discounts a thing in the first place? This is to encourage people to pay cash. This is to encourage people to be paying cash as soon as they can, as soon as it is possible. It is encouraging people to not take things on credit, but to pay it as soon as they can. So when people will be getting a cash discount or a settlement discount, they will be keen on paying the money because they'll be happy to receive the discount. So they'll be paying on time, right? So for example, a cash discount of 3% may be offered to any customers who pay within 10 days when the normal terms of business are 30 days credit. So this is given so it encourages and motivates the individuals to pay. Whilst offering this discount may encourage earlier receipt of cash from credit customers, there is still a loss of revenue to the entity which offers such a discount. So that we will come in a while. Okay, now let's see how are we going to do the accounting for the settlement discounts. An entity may receive a discount from its suppliers known as discount received. So if I am taking a discount from your company, I will be receiving the discount, so that is nothing but the discount received for me. The reduction in the payment to the supplier, discount received, will be noted in a memorandum column in the cash book at the time the payment is made. When summary totals are posted periodically from the cash book into the general ledger accounts, discount received will be as follows: debit payables, credit discounts received. Okay, don't get confused, we will just talk about it. So when we were doing the trade discounts, we did not open a new account. We never opened a new account saying discount allowed or discount received. We just deducted the value and we wrote the net value in the same account, right? So now what are we supposed to do? In the cash discount, we will be opening a new account, and the new account is known as discount received or discount allowed. So if I am a seller, if I give someone a discount, that will be my discount allowed, right? Why? Because I am providing discount for someone. And what about the buyer? For the buyer, it is discount received. Why is it discount received for the buyer? Because they are receiving the discount. So now here in the cash discount or the settlement discount, we will be opening these new accounts which are either discount allowed or discount received. So for a company, for a seller, for a person who is giving the discount, is discount an expense for them or an income? If I am giving you a discount, it is a positive thing for you, but it is a negative thing for me. Why is it a negative thing for me? Because I am facing a little bit of loss. That is why I'm giving you a discount. You are happy with it. It is an income for you. It is a gain for you. But it is a loss for me because I'm losing out on some of the money. So for me, it is an expense. It is an expense for the seller, and it is a income for the buyer. All right, are you able to understand what I'm saying? Now let's see how we do the accounting. So we just discussed the accounting, but we will still be doing this. Okay. So when we are receiving a discount, then the discount received will be credited. Why will it be credited? Because it is an income for us, and you know all the incomes are credited and payables are debited. Why? Because you're paying away something, right? We will be solving more questions. When preparing the final accounts, discount received is normally netted off against the purchaser's expenses to reduce the cost of sales. An entity may give its customers a discount known as discount allowed. This is a reduction in the revenue. I told you, reduction in the revenue. A settlement discount is different in nature to a trade discount. So now let's see how a trade discount differs from a cash discount. Remember that a cash discount is also known as a settlement discount. A trade discount is a definite reduction in the price that is given to a customer. A settlement discount is a reduction in the overall invoice price that is offered to a customer. It is for the customer to decide whether to accept this discount and pay the reduced amount paid within the required time scale, or whether to pay the full invoice amount at some time later date. So whenever you get a trade discount, that is something which is happening so that you buy more quantity. So there we are not opening any new account. We will just deduct the trade discount from the value, and that is what will be shown in the books. Whereas in a cash discount, we will be opening new accounts because the entity has an option to either avail the discount or not avail the discount. So you know how a cash discount or a settlement discount works. If a person pays the money before the due date, they will be availing this much of a cash discount. In practical terms, if a settlement discount is offered to a credit customer, there is no way of knowing at the point when the sales invoice is prepared whether the customer will take advantage of the discount offered and pay the reduced amount. This is known as variable consideration, as the seller does not know at the time of sales revenue is recorded whether the business will receive only the discounted amount or the full amount. Okay, so as we have just discussed before this how a cash discount or a settlement discount works, so we can never be so sure about whether a person will be availing the discount or not. Today I can be a buyer. Today I can come to you and I can say that I will be paying the money within 10 days instead of 20 days, so please give me the cash discount. You are not sure whether I will be giving you the money within 10 days or not. You can never be sure of it, right? That will only be sure when such a time occurs. So that is why we are saying that this is known as a variable consideration. So we need to consider both the situations. We need to consider both the situations. One situation is where we are happy and we are okay with giving the money and we do actually pay in advance, and the other situation is when we are not paying in advance. As the seller does not know at the time sales revenue is recorded whether the business will receive only the discounted amount or the full amount, because you are not sure yet. Variable consideration is dealt with as part of the 5-step approach to revenue recognition in Chapter 17, Preparing Basic Financial Statements. In practice, an entity should adopt one of the following approaches to deal with this situation, depending upon whether it expects the customers to take advantage of the discounts. So, we know that there are two types of situations. One is wherein the person pays in advance pays in advance pays in advance and avails the cash discount, and the other situation is when they do not pay in advance and they do not avail the. Okay, I know you're not able to read what I'm writing because my pen is not working. So the first situation is when the customer is paying in advance and availing the cash discount, and the second situation is when the person is not paying in advance and not availing the discount. Okay, so let us see this. Prepare the sales invoice for the full amount if the customer is not expected to pay early and claim the settlement of discount. If, as expected, the customer does not pay early, the full amount is due as normal. Or prepare the invoice for the reduced amount after applying the settlement discount if the customer is expected to pay early and be entitled to the settlement discount. Subsequently, if the customer does not pay early and additional amount is received, would be treated as revenue from the original sales transactions. The entity could raise a further invoice for the discount not taken. So this is nothing but the same thing which we have discussed, that in a situation when a person is expected to pay early, then you will be making an invoice wherein you will be showing that they have taken the settlement discount, and if they fail to pay it, then we reverse the entry, and likewise. So this we'll be discussing with the examples. Seller's perspective. In examination questions, when dealing with transactions from the perspective of the seller, it will be stated whether or not a credit customer is expected to take advantage of settlement discount terms for the purpose of calculating amounts invoiced and due from a customer, and to account for this approach is settlement discount allowed will no longer be need to be recorded separately as an expense. The following illustration shows the accounting requirements relating to settlement discounts from the perspective of the seller. Let's see this illustration. An entity sold goods to a customer on credit at a price of $200, and the customer was offered 3% settlement discount for a settlement within 10 days. How should this be accounted? So the first situation is when the customer was not expected to take advantage of the early settlement discount, and in the second is when the customer was expected to take advantage of the discount. Now let's see how it really is. So the invoice would consist of the following amounts. So what is the list price? It's given in the question. It is $200, and we need to subtract the settlement discount. Settlement discount is 3%, but in the first part, if you can see, it is mentioned that the customer was not expected to take advantage. So if that means that there is no discount for that person because the person is not expected to pay, so then you minus, and this is what will be the discount. If, as expected, the customer did not take advantage of the settlement discount available, the full amount of $200 should be paid by the customer. Upon receipt of the amount due, this would be recorded as follows. So how will it be recorded when you receive the money? When you receive the money, it is just going to be cash to credit receivables. Why? Because when the invoice has been made, and if the discount would have been given and if the person would have taken the discount, then the journal entry would be totally different. But in this situation, no discount has been taken, right? So we'll just be receiving the cash and we will be crediting the receivables since we have received. If, however, the customer did not take advantage of settlement discount terms, did take, they would pay 194. The receivable of 200 must be cleared even though only 194 has been received in full settlement. Okay, this is another situation wherein the discount has been availed by the person because the person is paying for the amount before the due date. So what will happen in such a situation? You will be receiving cash and you will be receiving cash. So this much cash you will be receiving and revenue, and then credit the receivables. So why am I saying revenue? Because for us, our revenue is getting reduced. Our revenue is getting reduced. Why? As I've mentioned to you right now, that when we are giving someone a discount, it is an expense for us, and our expense or our revenue is getting reduced. What is an expense? Our revenue is getting reduced. So since we are giving someone a discount, then our revenue is getting reduced. We are giving 3% of discount, right? So debit cash, we are receiving the cash from them of 194, and we're also going to be debiting the cash. After debiting the cash, we are going to be debiting our revenue of how many rupees, and we will also be crediting our receivables because initially that's how the entry is supposed to be. And okay, so that's how it is. This is the discount allowed entry. So let's see the B part. The B part is nothing but the customer was expected to take advantage of early settlement discounts offered. So in this situation, the customer is expected. So since the customer is already expected, the amount which is due from the customer is this much only. This much is only due from them, and that much only they will be giving us. Why? Because that's what is due from them. In the earlier situation, we did not expect them to take it. So in this situation, settlement discount is excluded from the accounting records in the same way as trade discount is excluded. If as expected the customer paid within 10 days to take advantage, so this is how it's gonna be. Okay, so since from the before only we expected that they will be availing the discount, so we will just put the direct value. This is how we did for the trade discount, so that's the same way we will be doing it in the cash discount. But why are we doing this? We are doing this only because we had expected this situation to happen. If we had not expected this, then we will be making a new entry and reducing the revenue, right? But here we are not reducing the revenue. Why? Because here when you see, the amount due was this much only and we are receiving that much only. But in this question, amount received was 200 and how much we got was 194. So that was differing. But in the B part, amount received is equal to the amount which was due. So in this situation, we will not be opening a new account. So we will be debiting the cash and we will be crediting the receivables. If, however, the customer did not take advantage of the early settlement terms, the full amount of rupees 200 will be due. When received, the additional cash received would be accounted as if the cash sale as follow. Okay, so now if the person was expected to take the discount but in the end they did not take the discount, in such a situation our revenue will increase because now even though our invoice was of less value, they will be giving us more. Why? Because the due date has passed. So we'll be debiting the cash, which is 200, because they'll be giving us 200, and we'll credit the receivables, which was in our invoice, which was 194, and we'll also credit the revenue. Why? Because revenue is getting increased, because discount is we are getting the back our invoiced amount. So I hope this is understandable. Even if it's not understandable, let's first just quickly discuss the whatever we have seen. So when you're talking about cash discount, there are various situations which you need to look into. Okay, so the first thing which you will be talking about when you're talking about a cash discount is that you either expect a person, you either expect for a person to pay, expect for a person to take the discount, expect the person to take a discount, or you do not expect, right? So there are two assumptions we can make: either that the person will be availing the cash discount, or the person will not be availing the cash discount. So when a person avails the cash discount, what will be the entry? When a person will be availing the cash discount, what will be the entry? So when a person is taking the cash discount, you know what the list price will be. So the list price will already be subtracted. So the amount which is due is going to be, let's say, XYZ. This much amount will be due, and we will subtract the cash discount. Let's say it is 1, and amount which is actually due from the person will be this much. So this is the amount due. What happens when you will get the money? So when you receive the money, then okay, let's first do the let me explain the same topic on a fresh page with a bigger space, so you will be able to understand. Okay, so you need to keep in mind that the cash discount is also known as the settlement discount. And now we will come to the first case. So in the first case, we are already expecting for the person to avail the cash discount. So in such a situation, what will we do? In the invoice, we will be having the list price. Let's say the list price is 100 rupees, $100, and let's say that the discount is 10%. Cash discount, we are talking about cash discount, so we will be subtracting it. So it is nothing but 10. So amount which is due, is gonna be nothing but 90. So this is how it is, right? And this is what we are expecting from the person. So after expecting from the person, if he pays on time, let's say that they pay on time. So if the person pays on time, which means they are availing the discount, this means that 90 was due from them, and we are supposed to take only 90 from them. Why? Because cash discount has been given and they are paying within the time wherein the cash discount is applicable. So how much we will be getting? So when the amount was actually due, what was our entry? When our amount was actually due from the other person, it was a credit sales, right? So for us it was receivables sales, right? So this was our entry firstly when we had to when we made the sales. Now, and let's see, so this was nothing but, we have recorded this as 90. Why have we recorded this as 90? Because the person has availed cash discount and we expected that they will be paying on a on the prescribed time. We expected them to avail the cash discount. So we already knew that they will most probably be taking the cash discount. That's why the list price, the amount due is 90, and this is what is due from them. Now let's see. If they paid on time, what will happen? If they paid on time, what will happen? So we will be receiving the cash and we will be crediting the receivables. With how much? With 90. Why? Because they have paid on time. Since they have paid on time, how much ever amount was due from them, that much we will receive from them. We will not be opening a new account. Why? Because we had expected them to do this. We had expected them to pay. That is why we had from before only expected them to do so. So our first initial entry was only on 90, right? Now this was the first situation wherein the person will be paying on time. Now let's assume that the person is not paying on time. Not paying on time. This is the second part. Why? So we had expected them to avail the cash discount, but now since the time has passed and they have not availed the whole thing. So what does this mean? This means that they will now have to be paying the entire amount, and now no discount is being given to them. But before all this, in the starting, we had expected them to take the discount. So when we expected them to take the discount, what was our journal entry? We expected them to take the discount, right? So since we expected them to take the discount, then we had this was our journal entry when we made the sales, and here we have 90. Why do we have 90? Because we expected them to take the discount. But now what happened is that they have not taken any discount. Why? Because the due date for the discount has been over and they are paying late. So now 90 rupees is not due. Now they need to pay the entire 100 rupees. Why? Because the discount is not applicable anymore, because the time is over. The cash discount time is over. They failed to match our expectations. We had expected them to take the cash discount, but they are not taking, which means 100 rupees have to be taken from them. But in our invoice, this is our invoice entry. In our invoice, we had only kept 90. Why did we keep 90? Because we expected for them to take the cash discount. So that's what is there in our invoice now. So now we will be opening a new account. I mean, not really a new account, but we will be checking of discount received and allowed, and we will be adding it or subtracting it from our revenue. So now tell me what happens when not paying on time. So in this situation, we will be taking cash from them, and we will be taking 100 cash from them, right? And we are going to credit receivables 90. So we are closing the account of receivables, which is 90, and we will be receiving revenue. We will be receiving the revenue of how much? Of $10. So did you understand why I did this? In our invoice, the amount was 90. So here we have already expected them to pay, but they didn't pay. So that is why we had to do this. So cash, we received 100, and credit, we closed the receivables account of 90, and our revenue is credited because revenue is getting increased by 10. So I hope this is clear. Now expected to avail, we have done all the conditions of expected to avail, right? Now let's see what happens when a person is not expected to avail. to. Not expected to avail. Okay. Now let's see what happens when a person is not expected to avail. So first, what entry do we do? When I know that this person will not be taking the offer, I know that this person will not pay before the time, I know that this person will never adhere to the timing and he or she will not be taking the cash discount, then I am sure that I don't have to give them any discount. I'm assuming that I don't have to give any discount. So in such a situation, the entire amount is due. 10% cash discount is there. That's the, I'm just giving you like we have done. But this person is not availing this. Why? Because they never pay on time. So we are assuming. So what happens in such a situation? So when you prepare an invoice, so we have debit receivables and credit sales, and we have 100. Here in our invoice we write 100 only. Why do we write 100 and why not 90? Because we already expect the person to not avail the discount. So now there are two situations. The first situation is when they pay late. When they pay late, as usual, as expected. So the first situation is when they pay as expected, when they pay late. So in such a situation, we receive the cash. And what else do? We receive the cash and we close the receivables. So we close the receivables as well. So what happens? This is what was expected and this is what we have done, right? Now in the second situation, we have expected, even though we had assumed that they will not be paying on time, so paid early is also known as availed the discount. Availed. They have availed. Here did not avail. They pay late as expected. Matlab not availed. Not availed. See, you will not be understanding this topic until and unless you are writing it with me. Okay, so they paid early, which means they have availed the discount. We had expected them not to avail the discount, but they have still availed the discount. So in such a situation, what are we supposed to do? We are going to open a new account, or what are we going to do? So the person will be giving us cash. The person will be giving us 90 cash and our revenue will be getting reduced right. Any confusion? The revenue is getting reduced. Why is it getting reduced? Because we are giving someone a discount. It is a loss to us, it is an expense to us, so it's getting debited. Clear? I hope you understood this topic very well. We also did the question on this. So now just pause the video, take screenshots. Actually, don't take screenshots. Write it down in your notebook. Write this entire thing down, and I want you guys to be so clear with the journal entries. Okay, I'm just scrolling it down so you guys can take screenshots of the same. So it is all based on pure logic. There is nothing which is very difficult in this. It's all just pure logic. Okay, so that's about it. When you talk about the cash discount and the sales discount, that is the topic. And let me just see what's the next concept. Okay. Now let's see the purchaser's perspective. Purchaser's perspective. So right now we just discussed the seller's perspective, that the journal entries which we saw was of the seller's perspective, right? So now let us see how the purchaser's perspective works. So purchaser's perspective will literally just be the opposite of what it was for the sales perspective. Right. So when dealing with the transactions from the perspective of a purchaser, the purchaser will initially record the full cost of the goods and will decide whether or not to take the advantage of settlement discount terms offered by the seller. If advantage of the settlement discount is not taken, the gross amount payable to the seller. If advantage is taken of the settlement discount received should be recorded as a normal as a memorandum. So now let's see the illustration and then we will come back to this. So what's the illustration? An entity sold goods to a customer on a credit at a price of $200 and the customer was offered 3% settlement discount for the settlement within 10 days. How should this be accounted in the books of the purchaser? State the net cost of the goods purchased. Okay. So there was this entity and this entity sold the goods to the customer on a credit for 200 and then the customer was offered 3% settlement discount. Okay. So the person takes the settlement discount. What is 3% on 200? 3% on 200 is nothing but 6. So it is $6 in this situation. In this question it is $6. Okay. So the purchaser would initially record the purchase of goods. So if I am purchasing something, I will always record the net value of the goods. So in this situation, what is the net value of the goods? The net value of the goods is $200. So purchases account gets debited and payables account gets credited. This is something which we've been doing from the past 5 chapters, so I don't think there's any confusion. So if the invoice was paid after the early settlement, then the full amount will be payable to the supplier with the payment record as follows. So if we are paying after the time of the discount, after the period of the settlement discount, which means we are not availing the cash discount, we are not availing the settlement discount, we have paid late, that means we have to pay the entire amount, which is payable accounts gets debited and our bank accounts or cash account gets credited. So the entire amount will be given since we are not availing the cash discount. And then we have alternatively, if the invoice was paid within the 10 day of early settlement, then what will be the thing? Payable account gets debited, our bank account gets credited, and we also credit the discount received. Why? Because the net cost of the goods is 194, which is net cost is nothing but the list price minus the cash discount. Okay, so I hope you understood what I'm trying to say. When a seller is writing this and giving a discount to someone, they will either increase their revenue or reduce their revenue, whereas when a purchaser has to put it in the books about the discounts, it will be a discount received for the person. The purchaser will open a discount received in their accounts, whereas a seller will just show it in his revenue, whether the revenue has increased or the revenue has decreased. Don't get confused and don't open a discount allowed account. A discount allowed account will not be opened in ACCA. That is something which we will be only doing in the grade 12. So however, there's nothing to worry about because we just show the same treatment of the discount allowed in the revenue only. So as we have done in the above question, so there's no confusion with that. But in the case of a purchaser, we always open a discount received. So when a discount we are receiving, it is an income for us, so it gets credited. Okay, now let's see what the test to understanding is. George owes a supplier Herbie $2,000 and is owed $3,400 by a customer Iris. George offers a cash discount to his customer of 2.5% if they pay within 14 days, and Herbie has offered a George a cash discount of 3% for payment within 10 days. George took advantage of the early settlement discount offered and paid Herbie within 10 days. So Iris was expected to take advantage of the early settlement discount offered to her, and therefore the sales invoice raised by George was prepared on that basis. However, Iris did not pay within 14 days and paid the full amount due after 30 days. Okay, so this is the what do you say, test your understanding, and we need to find the answer of this question. I will be discussing this question, test your understanding 3, in the next video. Till then, I would want you guys to solve this by yourself. Solve it by yourself, and after solving it, you can post your answers in the comment section below. In the next video, I will be sharing the solution of the question, and in the next video, we will also be doing the concept of the taxes, and then we'll be done with this chapter. Okay, so I hope you are able to understand this chapter so far, and it is a very easy chapter. Just make sure that you make notes and you write down whatever I am explaining, and you have to learn the journal entries, and it is very easy and it is very logical. In the next video, we will be doing with the final chapter, even that is very easy, and which is nothing but the sales tax, and we will be doing the test to understanding. Thank you.